Major banks just moved $1 trillion. They know something. Section 1. The pattern that repeats before crises. Across the last century, the same pattern appears before major financial collapses. In 1929, 2008, and 2020, large investors reduced exposure to stocks and moved into a small set of protective assets months before markets crashed. These moves were not predictions. They were responses to rising debt, inflated asset prices, and tightening credit. Section 2. Why 2026 matches past warning signals. Global debt has reached extreme levels relative to economic output. Interest costs are rising faster than incomes. Corporate refinancing pressure is increasing. Commercial real estate values are falling, and equity valuations remain historically high. At the same time, geopolitical tension and currency stress are increasing worldwide. Section 3. Asset 1. Physical gold. Large investors are accumulating physical gold rather than paper claims. Gold carries no counterparty risk and has preserved purchasing power during inflation, deflation, and currency instability. Central banks and private wealth managers are increasing gold holdings as trust in paper assets weakens. Section 4. Asset 2. Cash and short-term treasuries. Holding cash and short-term government securities provides flexibility. During crashes, asset prices fall rapidly. Those with liquid capital can buy quality assets at deep discounts while others are forced to sell. This strategy has preceded every major wealth transfer. Section 5. Asset 3. Distressed debt. When companies struggle to refinance debt, bonds fall sharply in price. Experienced investors buy these bonds at discounts during panic and hold through restructuring. Historically, distressed debt delivers strong returns after crises stabilize. Section 6. Asset 4. Productive hard assets. Farmland, water rights, timber, and energy infrastructure produce essential goods. These assets generate income and retain value regardless of currency changes. When inflation rises, the output and land value often rise with it. Section 7. Asset 5. Defensive businesses. Investors favor companies that sell necessities and have pricing power. Utilities, food producers, payment networks, and infrastructure providers tend to fall less during downturns and recover faster. These businesses remain profitable even during recessions. Section 8. The core insight. Major financial crises are not random. They follow recognizable conditions. Wealth shifts from those who react late to those who prepare early. The movement of large capital today signals preparation, not panic. Section 9. The practical response. Reducing exposure to overvalued assets, increasing liquidity, and focusing on resilience improves survival during downturns. Preparation creates options. Waiting removes them. Section 10. The final takeaway. History shows that protection comes before opportunity. When large capital moves quietly, it reflects risk awareness. Understanding the pattern allows informed positioning instead of forced reaction.